Welcome to the deep dive. Today, we're tackling a question that feels both ancient and, well, futuristic, doesn't it?
It really does.
Can blockchain technology truly redefine the future of money? We've gathered quite a stack of sources, reports, studies, market analyses to really dig into this.
hmm
Our mission for this deep dive with you is pretty simple but crucial, we think.
Yeah, what are we trying to do here?
We want to journey through all this material with an open mind, Question the hype, sure, but also recognize the technology's potential. Could it truly transform money's future?
Because the financial world really does feel like it's at a crossroads.
Absolutely. Traditional banking is facing some, let's say, serious challenges, and blockchain is emerging as this, well, significant force.
And it's not just about the cryptocurrencies you might read about in the headlines.
Right.
It's about the underlying tech, the blockchain itself, and whether it can solve some, fundamental issues we've had for centuries in how we handle value and transactions.
Okay, so let's unpack this. Let's start right at the beginning. Why are we even looking for something new? What are the real pain points in today's systems that the sources point out?
Well, it's interesting. Traditional banking, it has deep roots, right? You can trace it back to medieval goldsmiths, institutions like the Bank of England from way back in 1694. It's a system built over a very long time.
But the sources are pretty critical about its drawbacks now in the modern era.
They really are. Significant drawback.
And these drawbacks, they impact real people, real businesses, don't they? Like just how slow things are.
Absolutely. Speed, or the lack of it, is a major frustration highlighted in the material, especially for cross-border payments.
Ah, yes, international transfers.
Exactly. The World Bank noted in 2023 that these can still take 3 to 5 business days.
3 to 5 days. Wow.
Yeah, think about the friction that creates for businesses relying on those payments,
Right.
or for the over $700 billion in global remittances sent every year, people supporting families abroad. That delay isn't just inconvenient, it's a real economic cost.
And the cost itself. Sending money, especially internationally, it just feels disproportionately expensive sometimes.
It really adds up. The sources point to high fees. Wire transfers, for instance, often average $15 to $50,
Just for one transfer.
right? Plus, you've got foreign exchange markups.
Mm.
These costs, they just eat into the value being transferred, and this is a huge barrier, especially for the 1.4 billion unbanked adults globally. That's according to the World Bank's 2021 Global Findex database.
So high fees make formal financial services basically inaccessible for a lot of people.
Exactly.
Okay, so speed, cost. Security is another big one, right? Even though banks spend frictions on it, you still hear about major breaches.
Vulnerabilities definitely persist. The sources mention these high-profile incidents, like the 2016 Bangladesh bank heist, $101 million stolen through cyber attacks on the SWIFT system.
Wow.
And the FBI reporting a 20% increase in financial fraud cases just in 2024. Well, it underscores that these traditional systems are still major targets.
Then there's accessibility, which you touched on with the unbanked. It's not just about cost. Sometimes it's just about not having a bank nearby. Infrastructure.
Right. Persistent barriers remain, particularly in developing countries. The World Bank noted that even in 2021, only 48% of adults in sub-Saharan Africa had a bank account.
Less than half.
Yeah. Infrastructure gaps, poverty.
Mhm.
It creates this kind of systemic exclusion.
And finally, the sources talk about a lack of transparency. You often don't really see clearly where money is going or how decisions are made.
And what's fascinating, or maybe worrying, here is how that opacity can unfortunately help facilitate illicit activities. Money laundering, corruption.
Yeah.
The UN estimates something like $1.6 trillion is laundered annually.
Trillion. Good grief.
So you take all these issues together, the slowness, the cost, the security risks, the accessibility problems, the lack of transparency, it collectively explains why there's this growing skepticism towards, maybe outdated systems.
And a real demand for exploring alternatives.
Exactly. Which paves the way for looking seriously at decentralized solutions like blockchain.
So that paints a really clear picture of why we're looking for something different. Okay, let's shift gears now. What is this blockchain thing anyway? How does the source material describe how it actually works and maybe how it tackles some of those problems?
Okay. So at its core, blockchain is described as a decentralized digital ledger.
A digital ledger, like a shared record book.
Exactly. Think of it like that, a shared, continuously updated record book, but it's distributed across a whole network of computers. These are often called nodes.
And that distributed structure is key, right? Because it removes the need for a central authority, like a single bank holding all the records.
Precisely. That was the foundational idea introduced by Satoshi Nakamoto through Bitcoin back in 2008. Instead of one central database that could be a single point of failure or control,
Yeah.
transactions are grouped together into blocks. Each new block is then cryptographically linked to the previous one. It forms this chain,
Yeah.
an unbreakable chain, ideally.
Which makes it transparent because, in theory, anyone on the network can see the transactions
Hmm.
and, crucially, immutable. You can't go back and secretly change anything once it's on the chain.
That's right. Once a block is added, it's secured by the network. They use these things called consensus mechanisms. You might have heard of proof of work or proof of stake.
Right, those terms come up a lot.
Basically, it means the computers on the network have to collectively agree that the transactions in the block are valid before it gets added to the chain. That collective agreement is what prevents alterations. It's really clever.
And that decentralization, having the data spread out, that sounds key to security too, if there's no single server to attack.
Exactly. Data is distributed, often globally. It massively reduces the risk of a single point of failure that hackers could exploit. There was a 2024 IBM study looking at blockchain's potential in financial services.
Yeah.
It estimated it could help cut fraud losses by about 30%.
30% is huge.
It is. And transactions get validated very quickly by the network using these cryptographic algorithms, often within minutes. Now, some blockchains are faster than others, that's true.
Sure.
But the sources note that even something like a Bitcoin transaction, which has known speed limitations, is still often significantly faster than many international bank transfers we talked about earlier.
Okay, now here's where, for me, it gets really interesting. Adding functionality beyond just recording transactions. Smart contracts. The sources talk about these a lot. What are they?
Yeah, smart contracts are a big deal. They're essentially self-executing agreements. The terms of the agreement are written directly into code on a blockchain platform.
Like Ethereum. That's the one you hear about most with smart contracts.
Exactly. Ethereum, pioneered by Vitalik Buterin around 2015, really popularized them.
So they automatically trigger actions when certain conditions are met, like if this happens, then do that.
Yes, that's the power. If the code says when X happens, do Y, the contract executes Y automatically. You don't need an intermediary, a lawyer, a bank, whatever, to approve or process it.
Can you give an example?
Sure. Think about insurance. A smart contract could hold the premium, and if a verifiable event happens, like a flight delay reported by a trusted data source, it could automatically release the insurance payout to the policyholder.
Without needing someone to manually process the claim.
Right. This automation, combined with the often significantly lower transaction fees on many blockchain networks, the sources mention fees sometimes under $1 on networks like Ripple, it presents a stark alternative to the cost structures in traditional finance.
And you mentioned accessibility earlier. How do things like blockchain-enabled mobile wallets specifically help the unbanked problem?
Well, platforms built on networks like, say, Stellar can facilitate these mobile wallets. They allow individuals, even in areas with very limited banking infrastructure, to access financial services.
Just using their phones.
Just using their phones, they can send, receive, hold value directly. It bypasses the need for physical bank branches, which are often completely inaccessible to them. This tech really challenges that old narrative that centralized institutions are the only way to structure finance.
Right. It pushes us to reconsider who gets access and how.
Definitely.
Okay, that makes sense. So it's clearly not just theoretical potential anymore. Let's look at some of these real-world applications mentioned in the sources. Where are we actually seeing this technology making a difference today, beyond just, people trading crypto?
Yeah, there are some really compelling examples showing practical use cases. Cross-border payments is a major one. It directly addresses that speed and cost pain point we started with.
Okay.
Companies like Ripple, using their XRP ledger, are enabling international settlements in literally seconds.
Seconds compared to days with something like Swift.
Exactly.
Yeah.
That's a huge difference in efficiency for global commerce.
Absolutely. Any specific examples of that in action?
Yeah, the sources mention a 2023 partnership between Ripple and the bank Santander. They processed something like $10 billion using the technology.
10 billion.
And reportedly cut costs by 60%. While streamlining remittances, particularly flowing into Latin America, it directly tackles those issues of speed and cost.
Okay, that's payments. What about supply chains? That seems like a natural fit for blockchain's transparency and that immutability thing.
It really is. Walmart's collaboration with IBM using their Hyperledger Fabric platform is a key example cited.
Yeah.
They've been using it since around 2016.
What do they use it for?
Tracking food products, for instance. From the farm through the supply chain right to the store shelf, it creates this immutable record.
So you can ensure authenticity and maybe track recalls more easily.
Precisely. And it also speeds up payments to suppliers. A 2024 pilot in China reportedly saw payment delays for suppliers slashed from 30 days down to just 48 hours.
Wow, that's huge for small suppliers.
Huge. And what's fascinating here is how tracking goods like this on a blockchain can help combat fraud. Counterfeit goods are a massive problem. The OECD estimates it's like a $50 billion annual loss globally.
So blockchain builds trust and verification into these really complex global networks.
That's the idea, by making things transparent and tamper-proof.
Okay. And of course, we have to mention cryptocurrencies themselves. They're the most visible application, even if that weren't the only thing impacting the future of money.
Yes, definitely the most visible, led by Bitcoin and Ethereum, primarily. The sources note their combined market cap exceeded $2 trillion in 2025.
$2 trillion. That shows their significance as at least an alternative asset class.
For sure. And in some situations, they act as an alternative to traditional fiat currencies,
Yeah.
particularly in places experiencing hyperinflation.
Yeah, right, where the local currency is collapsing.
Exactly. Sources mention Bitcoin adoption surging, like 60% in Venezuela in 2023, as people desperately sought a stable store of value.
And it's not just private cryptocurrencies. We're even seeing governments getting into the game, exploring central bank digital currencies or CBDCs.
Right. That's a really interesting development. China's digital yuan is probably the most prominent example. It's been in testing since 2020.
And they're actually using it.
Yeah, reportedly processed $13 billion in transactions by 2024. This shows that even state-controlled finance is looking at integrating aspects of this technology.
Which suggests maybe the future isn't purely decentralized or purely centralized, but maybe some kind of hybrid.
That seems to be what these examples point towards, yes. A potential blending of both approaches.
Okay, seeing these applications really makes you wonder about the broader impact. What's the potential scale here? How much could this technology really change the future of money based on what the sources project?
Well, the potential scale is seen as significant. PwC, for example, projects the blockchain market could reach $1.7 trillion by 2030.
Trillion again, that's a huge number. Where's that value coming from?
A lot of it is tied to financial inclusion. That's a major point of optimism in the sources. The UN actually predicts blockchain could help connect 1.1 billion unbanked people by 2030.
A billion people.
Largely through these mobile-based solutions we talked about, solutions that bypass the need for traditional banking infrastructure.
Like that M-Pesa example in Kenya you mentioned, is that tied to blockchain now?
Well, the sources mentioned the integration of M-Pesa, which is already huge for mobile money in Africa, with platforms like Ethereum since 2022.
Okay.
And that integration reportedly reduced transaction costs by 40% for rural users. It's also enabling microfinance platforms in places like India to grow significantly. This potential to include populations that have been historically excluded. It's profound.
It really is. And what about efficiency gains? Not just for users, but for the financial institutions themselves.
That's another huge area. What's fascinating is the potential for streamlining operations within existing finance. A 2024 report from the Bank of International Settlements, the BIS, suggested blockchain could save something like $120 billion annually in global banking operations.
How?
By improving these complex, often manual processes like KYC, know your customer verification, making them faster and more secure.
And those smart contracts again?
Exactly. JP Morgan has a platform called Onyx. The sources say it uses smart contracts to automate things like loan approvals, cutting processing times from weeks down to just hours.
Weeks to hours, that kind of efficiency must inevitably impact jobs in the sector, right?
It very likely could. McKinsey estimates that as these processes become more automated, perhaps around 10% of jobs in the finance sector might shift by 2030.
Shift, meaning disappear or change.
Probably a mix, requiring new skills, new roles related to managing and developing this technology, while some older roles might become redundant.
But it's definitely not all smooth sailing, is it? The sources also highlight some pretty significant challenges that temper this optimism. We have to talk about those too.
Yes, absolutely. And it's crucial to look at these realistically. Scalability is a major technical hurdle.
The transactions per second problem.
Right. Bitcoin, the original, handles around, 7 transactions per second, maybe? Visa, for comparison, can handle closer to 24,000 TPS.
Huge difference.
Massive. Now, newer blockchains are much, much faster, but matching the sheer volume of global retail payments, that's still a significant technical challenge for many networks.
And then there's the energy consumption issue, particularly for those older proof of work networks like Bitcoin. It gets a lot of criticism.
It does, and fairly so. Sources note that Bitcoin mining used about 0.5% of global electricity in 2024. That's a considerable environmental footprint.
But are there solutions being worked on?
Yes. It's important to note that newer solutions, like those proof-of-stake consensus mechanisms we mentioned, are specifically designed to use dramatically less energy. So the aim is to mitigate this concern for future applications, but it's still an issue for established networks.
And regulatory uncertainty, that seems like a constant shadow hanging over the whole space.
Absolutely. Governments and financial regulators globally are still figuring out how to classify and oversee these technologies. Is it a currency? A commodity?
Mm-hmm.
A security?
Yeah.
The US SEC's 2023 crackdown on certain unregistered crypto offerings is just one example of this playing out. This lack of clear rules creates uncertainty for businesses, for users.
Which probably slows down adoption.
Exactly. It makes widespread adoption more complex and suggests maybe a slower, more evolutionary shift rather than an immediate revolution.
Okay. So, considering both this massive potential and these very real challenges, who stands to benefit the most from this technology, according to the material? And maybe just as importantly, who might actively resist it?
Well, the beneficiaries highlighted in the sources seem pretty clear. First, the unbanked population we've talked about. Those microfinance platforms in India enabling access grew 25% in 2024, for example.
Okay, so financial inclusion.
Yes. Then, small businesses could benefit hugely from faster, cheaper transactions, especially cross-border. Tech innovators and the companies actually building on blockchain think Ripple, consensus is they've seen soaring valuations.
Right.
And ultimately, consumers could benefit from lower fees and more efficient financial services if that potential is realized.
Okay, that's the pro side. On the other side, traditional financial institutions, like the big banks, they must see this as a potential threat to their established business models, right?
It certainly could. Accenture put out an estimate suggesting banks face a potential $100 billion revenue loss by 2030 due to disruption from this technology.
Wow. So how does that resistance play out?
The sources note it often manifests through things like lobbying efforts, trying to shape regulation in their favor, and maybe a generally slower pace of adopting the new tech compared to more nimble startups. Understandable, perhaps, given their existing infrastructure.
And governments, of course, are major players here, too. They're balancing innovation with maintaining control, aren't they?
Definitely. Governments are naturally wary of anything that might erode their control over monetary policy. That's fundamental to their power.
So is that why they're interested in CBDCs?
That seems to be a key driver, yes. Exploring central bank digital currencies like the European Central Bank's digital euro pilot in 2023, it's potentially a way for states to leverage the underlying blockchain technology efficiency, traceability, while keeping central control over the currency itself.
So it really highlights this ongoing tension, doesn't it, between the push for decentralized innovation and the existing ingrained power structures of finance and government.
Exactly that tension.
Which brings us, I think, to a really critical point, separating the hype from the practical reality. There's clearly incredible potential here, but there's also been a lot of noise, a lot of, let's face it, unrealistic expectations sometimes.
Yeah, this raises an important question about the whole narrative, doesn't it?
Yeah.
It's vital, as you say, to approach the claims made about blockchain with a critical eye.
We've seen bubbles before.
Absolutely. We've seen historical examples where hype just completely outpaced substance. Remember the 2018 ICO boom, initial coin offerings?
Oh, yeah, Wild West stuff.
Totally. An estimated $12 billion went into projects that eventually collapsed. Many due to outright fraud, others just because the tech wasn't viable or the idea wasn't sound.
So a reminder to be skeptical. And even within the technology itself, there are still limitations today that need addressing, right? Beyond scalability.
Yes, interoperability is a significant one mentioned in the sources. How do all these different blockchains talk to each other?
Right. If my money is on one blockchain, can I easily send it to someone on a different one?
Often, not easily. The sources note that in 2025, there are over 1,000 blockchain networks out there. Many lack unified standards. That makes it difficult for them to seamlessly communicate and transfer value between each other without complex bridges or intermediaries, which kind of defeats the purpose sometimes.
And the very idea of decentralization, is it always as pure in practice as the theory suggests?
That's another fascinating point the sources raise. While the ideal is this fully distributed power to the people network,
Yeah.
the reality can sometimes be different. They point out that on some networks, like Ethereum, at least in the past, a few very large mining pools controlled a significant chunk of the network's processing power.
Which sounds a bit like centralization creeping back in.
It potentially could, yes. It raises questions about how truly distributed the control actually is in practice for all implementations. So all these factors, the past hype, the interoperability issues, questions about practical decentralization, they challenge that idea of a complete sudden financial overhaul.
And it's just maybe a more likely path.
A more likely path seems to be this hybrid evolution, where blockchain technologies complement, enhance, and integrate with existing financial systems rather than completely replacing them overnight.
Okay. So we've taken quite a journey in this deep dive. We've looked at the significant flaws in traditional banking, the issues with speed, cost, security vulnerabilities, accessibility, transparency, all creating this real demand for something new. We've unpacked what blockchain is, how it functions as this decentralized ledger, explored key features like immutability, transparency, and those powerful smart contracts.
Right.
We've seen compelling real-world examples, speeding up cross-border payments, making supply chains more transparent, enabling cryptocurrencies, and even powering government-backed digital currencies.
We've weighed the massive potential, especially for financial inclusion and efficiency gains, against those very real challenges.
Yeah.
Scalability, energy use, and the tricky landscape of regulatory uncertainty.
And we've considered who stands to benefit from this shift versus who might resist it, exploring that fundamental tension between disruptive innovation and established power structures.
And having explored the journey through these sources, it really brings us back to that core question they seem to pose.
Which is?
Will blockchain fundamentally change money forever? Or will it instead primarily enhance it, improve it, by coexisting and integrating with conventional finance?
That really is the multi-trillion-dollar question, isn't it? And for you listening right now, the sources kind of leave us all with a final thought to consider as you reflect on everything we've discussed.
Yeah, what are your thoughts?
Do you see blockchain as the inevitable future of money, a complete replacement? Or do you see it as just another powerful tool, albeit a revolutionary one, that will reshape things alongside what's already there?
It's definitely a question worth pondering as this technology keeps evolving and its impact continues to unfold day by day.
Absolutely. Well, thank you for joining us for this deep dive into blockchain and the future of money.